Friday's end-of-day rally appears to be nothing more than a short squeeze with the opportunity to set a nasty daily lower high. And there's a certain level that will confirm whether or not we'll be looking for more downside. Add into the mix two major economic reports this week, both the ISM Services PMI on Wednesday and the full labor report on Friday, and we'll be monitoring the recession narrative as well. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame chart now that the February bars have officially closed out. What do we see in terms of candle structure and location? Structure-wise, we do have a bearish inverted hammer where in the upper wick we can clearly see that sellers stepped up and they were able to push prices back down for a close just a hair over the opening print. Now, of course, we know the end-of-day rally on Friday has a lot to do with moving off of the low of the February monthly bar, and we'll talk about that on the daily in just a moment. But definitively here, the point to take away is that sellers are stepping up near the highs of the monthly range. And this is important because on the location front, notice that on the bar-to-bar count, we did set a higher low as well as a higher high. I would actually call this an attempted breakout on the monthly time frame chart because prior to February, the December and January highs are roughly equal. The fact that we've closed so firmly back down inside the midpoint of what I would consider at this point a multi-month range seems to make this look more like a failed breakout than anything else. So both the structure and location probably lean a little bit more bearish in the immediate time frame when we're just considering the bar-to-bar count. But if we zoom out here, I think it's very important to remember that we still have lows, we have monthly higher lows, we have monthly soft higher lows, and we're currently trading at the highest high of the monthly trend count. So therefore, the question I would pose is it reasonable that the monthly could pull back and set some kind of higher low? I think the answer to that question is absolutely. And as we described in January, once that monthly bar closed, I've been arguing and I've been sort of an advocate for 525 for a number of reasons here. We'll talk about why in just a moment, but you could imagine that clearly to get here, I'm not denying that intra-week, intra-day, there's probably going to be bearish opportunities. That is 100% likely if we're making it to 525 for a monthly higher low. So this is where it's very important to understand your time frame of analysis needs to match your time frame of execution. If you're a longer-term investor, this is probably important. If you're waking up on Monday this upcoming week and saying, hey, I can't wait to scalp the 5-minute time frame chart, this probably doesn't mean so much to you, right? So generally, if we're trying to take a holistic look at the market trend right now, the higher time frames really aren't damaged in any way. And it's very important that we talk about this, especially around the narrative of, hey, is the market due for a larger crash? Because as we always say, every single monthly close, whenever the topic of discussion is like, hey, market crash, is it going to happen or is it not? We know that the monthly trend needs to be down before anything more painful is going to happen in the market. Remember that in the great financial crisis, we've set a monthly double top, we've set a lower high, a lower low, and then the most painful moment takes place in the charts, in the market, right? We can even go back to the dot-com bubble bursting. We have this similar pattern with the monthly double top. We have a previous set of lows. We have a lower high, a monthly lower low. So we're in a monthly downtrend. You get panic mode number 1, number 2, and the big one, number 3, capitulation straight into the lows. In both of these instances, the monthly trend had flipped to down prior to a stronger, more protracted move to the downside across the market. Another metric that we can use here to gauge the strength of the trend is the 20 SMA on the monthly time frame. You'll notice here, as this double top is put into place, we're actually testing, the neckline basically is the monthly 20 SMA. When we get underneath the 20 SMA with a lower high, bad things happen in the market. As we take a look at the great financial crisis, notice it's the same exact thing. Double top, neckline is basically the 20 SMA. The retest lower high is under the monthly 20 SMA. And this happens all the way up until, let's take a look, the 2022 drawdown as well. Notice that we have highs, we have lower highs, we had lows, we have lower lows. We break the 20 SMA and things get a little bit worse. Where are we relative to this 20 SMA on the monthly? It's not even a conversation point as of the close on February. So if we're gauging the strength of the trend here, It's absolutely stronger than what we've been dealing with in the past. There is room, in my opinion, for a higher low pullback to emerge, and don't get it twisted. That will allow for some downside intra-week, intraday opportunities to present themselves, which are absolutely shortable. So understand one more time, I'll say it one more time because it's very important. Understand your time frame of execution must match your time frame of analysis. A couple of reasons why I'm very interested in this 525 if there's a larger monthly pullback is because it aligns with the monthly 20 SMA. There's also alignment here if we come in with the Fibonacci retracements from the bottom of 2022 to the all-time high. That's over the 38.2. What about from our last major monthly high or low? That's this level right here. From here to here, now we've established a little bit of a zone. Notice how in this area, it's sort of the key level. Price action is always going to take the top spot, if you will, in terms of my priority levels, but the 38.2 is slightly above, it's slightly below when measuring a Fibonacci retracement from local lows here and here to the all-time high. Another reason why a pullback might actually be reasonable at this point in time, dare I even say it, we've already talked about the candle structure and the location, the failure back down underneath the all-time high, but check this one out, and we talked about this a while back. If we take a look at the measured move from the sickness bull flag from here to here, this is the measured move. We're home. Ding, 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 chicken dinner, winner, winner, whatever you want to call it. We've made the move. This is complete from a pattern perspective. What about this bull flag coming in from here, coming to here, and pull back low over here? What do you know? And remember, we've talked about this as a target for a very long time, around 610 on the monthly time frame charts. We are home at those targets. Is it possible that if this consolidation yields a pullback, we could seek a higher low? The answer to me is absolutely. So that's my take through the higher time frames. Let's go ahead and drop it on down to the weekly time frame chart. Let's get a little bit more granular here, and let's see what's going on from this perspective. Of course, candle structure and location will kick us off on the weekly as well. What do we see? Certainly a more hammer-esque style bar. The difference here just being that this is a solid red-bodied bar. So therefore, sure, buyers did technically step up off the lows of the weekly range, as we know Friday, towards the end of day, and they pushed prices higher, but only towards the midpoint of the weekly range. I wouldn't really consider this, I would not consider it whatsoever, a strong display of strength and oh my goodness, this market's got to rally and go take out the all-time high. Is it bullish? Is there some buying pressure? Yeah, but it's not the best thing I've ever seen. Of course, a green-bodied bar would be way more impressive because that would imply we would have taken out the opening print and expanded range in the upward direction with a firm close over the opening print. That's not the case with this weekly structure. As we're considering the bar-to-bar count on the weekly time frame, you'll also notice that we have a lower high as well as a lower low, and we've closed underneath the previous week's range. We've closed right at the weekly 20 SMA, which, by the way, is the orange moving average on our screen here. So to me, that's bearish in terms of location. Lower high, lower low, closing under the previous week's low. From a grand scheme perspective, from an overall trend perspective, I should say, grand scheme, what is that? An overall trend perspective also outlines that we've basically made equal lows at this point as well. Recall that we were trying to sort of, make up the fact that, okay, it's not really been a daily downtrend in here. We had the deep seek gap down. We had the tariff gap down. We didn't really have a protracted daily downtrend, but we were trying to argue for soft higher lows on the weekly time frame chart to persist there. And trading back up towards these highs, we technically made a new higher high. Now we don't really have that opportunity to continue holding these soft higher lows as a component of the trend count. And really, on the weekly, I would say that this is much more of a balance range, right? And certainly you could consider this look above and fail. We'll talk more about that on the daily in just a moment. But where are we in the weekly balance is the next takeaway. It's the midpoint. This is the midpoint of a weekly range where I don't think it's going to be beneficial to make a big, bold call as to, oh my God, the weekly's crashing, or oh my God, the weekly's trying to break out. We're just not there. We're smack in the center of the overall range after failing to hold a potential higher low in the trend count. Now, of course, the lower wick is something that we'll talk more about. And yes, buyers stepped up towards the lows. But until we can actually build this out into like an ascending triangle, something where we clearly have, a trend line that maybe looks like this, a flat set of highs. If this remains in the range, another weekly higher low and we compress, maybe there's another shot at a break to all-time highs. But going forward, I would think after the failed breakout over here, we want to be cautious. Now, I want to be clear about my language here. We want to be cautiously bearish. We don't want to be bearish. Oh my God, the market's crashing and going to zero. but we want to be cautiously bearish after a failed breakout that if we are to move underneath the low of last week, basically, which represents, I would say, the bottom end of the balance range here, if we take this low out, what do we have on the weekly? Certainly left, maybe right, as in a double top, left and right shoulders. There's no head, but double top underneath the neckline of the double top, and I would certainly think that there's the opportunity for further downside on the weekly time frame. In the S&P 500, I would be acutely aware of this level here, which is closer to 562, the weekly 50 SMA, but as described on the monthly time frame chart, we know that there's technically room to pull back for a monthly higher low into that 525 level. So how do the time frames come together to actually paint the picture? Well, if the weekly falls underneath the neckline, which I would start arguing is the previous week's low, let's use 580 as a round number, now we start to fall into a weekly downtrend. If a lower high is set underneath the balance range, I would at least look for the weekly 50 SMA, and then beyond that, we're monitoring for another weekly lower low, lower high, and over time, if the weekly trend firmly flips to down, that's how we get to 525. You can see that, again, closing in the midpoint of the balance range means that we do not want to jump the gun on this outcome, but that is the threat that we have to be prepared for as we move forward. The idea here is preparation, not sort of anticipation or jumping the gun and actually actioning on this before anything bad actually takes place. The hold on Friday sort of gives buyers one more opportunity. Maybe I shouldn't even say one more, but the continued stance of like, okay, we really should remain neutral in this weekly trend, or balance, I should say, before making a bold call in any other particular direction. So with that, what other supporting evidence do we have on the weekly time frame? Let's come in from our most local low that we've been using over the last little bit. Let's continue to reinforce the idea that all of this consolidation has technically taken place over the Fibonacci 38.2. So in the grand scheme of things, could this just act as a weekly bull flag? Absolutely. Have we broken the flag lows? The answer is no, which is why we're being patient for that 580 to give out before we make a more bearish call on the market from the higher time frame perspective. Again, we'll talk smaller time frames as the video goes on here. What about if we come in from the bottom of, this is basically the election push to the upside, right? To the all-time high. We were sort of mostly interested in the sustained price action over the Fibonacci 38.2 here as of the close of 2 weeks ago. Of course, now we've broken that Fib 38.2. We did see a hold of the 61.8, and we've closed back inside of no man's land between the two major zones from a Fib perspective. So in here, no bold calls. If we're under the 68.1, that's where I would start to think again that larger concerns emerge for this market when we're using the Fib perspective. Let's go ahead and throw on the weekly, I was going to say intraday, but these are the weekly, of course, anchored VWAPs. Let's make note that a majority of the cluster has tried to act as support, but we're not staying above the entire cluster. We pushed into it. So that's sort of like a warning shot across the bow, if you will. It's not the end of the world. We didn't close down here. We didn't take out the bottom anchored VWAP, but it's certainly suggesting that the strength of the trend as we get to the smaller time frames has deteriorated here. Obviously, that sort of speaks for itself as the market's been more sideways than anything else. It's not continuing the uptrend in a clean and orderly fashion. Let's take a look at the market's profile from the lens of at least a volume profile perspective here. Weekly time frame chart, and what we should do is just drop this down to like a 6-month chart just so we're aware of the local stuff only. And the point I would like to make here is that on the attempted break, there's, in theory, this is a blue sky breakout, there's nothing above that should act as resistance. So the fact that now we're back down underneath the high volume nodes, notice that this, sort of yellowish line in here, I'm going to overlay it with white, that represents the point of control, the most traded level over the last little bit here through this balance range. The fact that we've closed underneath means to me that we have quite a bit of overhead supply here. So if things were going to improve, we've talked a lot about the caution to the downside, but if things are going to improve over the next week or so in the market, I would want to see price acceptance up and over this point of control, which is basically the volume shelf around 599.50, let's call it 600, right? That's our level on the daily time frame chart, or at least it has been over the past little bit. It's a psychological area. If we're over 600, that represents an improvement from the weekly perspective. Now let's drop it all the way down to the daily time frame chart. Don't worry, we'll still cover the hourly as well, but let's get down to the daily and let's start to pick this apart, because in the intro I said that there was a very obvious level which is going to act as the line in the sand, and that level is right here. Lo and behold, it's very close to that point of control from the weekly we were just talking about, where there's overhead supply at 599.65, 600, the round figure we were just mentioning. We'll talk more about that in detail in just a moment, but firstly, let's evaluate the weekly expected move relative to some major inflection points here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. The upper bound is sitting at 606.32, implying a lower high relative to the all-time high. That is bearish. If we're contained by the lower bound, the number is at 581.85, and it's basically an equal low on par with the low from last week. Now, one word of caution here is that obviously the market has absolutely blown through the lower edge of last week's expected move. Is this an end-all be-all area of support here? Absolutely not. You can see that Friday's session by itself basically is the entire expected move, right? If you take a look at this, that's basically where we measure the expected move from. The low of day is right there. So is it unreasonable that the market may breach the expected move? Absolutely not. So although, yes, this is an equal low, I really don't think that it would be unreasonable for a lower low to be set in the upcoming week's worth of trade, especially with some of these fundamental catalysts, which we'll get to as the video wears on. So expected move does strike me as being bearish here, even if you want to take it at face value. This is undoubtedly a lower high, and this, of course, is an equal low. There's nothing, in this matrix here that suggests we're in a bullish uptrend. So, speaking of the trend, we know that we have highs, and this was the highest high in the trend count, and we've seen an aggressive breakdown here straight into a lower low. The base case, as mentioned last Saturday, has been broken. The base case prior to what we're dealing with right now was that this was the next higher low. This, over the 50 SMA, wanted to act as the next higher low, and when we were consolidating up here, the ideal higher low was to keep price over 606.75. We talked about the base case breaking down here, and now walking forward, I think it's important that we establish a new base case, which is that we're technically in a daily developing downtrend until proven otherwise. And in a downtrend, you're usually looking for lower highs and lower lows. Well, lo and behold, not to use the word low again, pun intended, we have the lowest low in the sequence, and any lower highs underneath the key level that I just described as really representing overhead supply keeps us in a daily downtrend. So when I say that Friday's rally into the close was a short squeeze, this doesn't strike me as new money buyers stepping up into the market. This strikes me as a market that was extended through the lower edge of the expected move, which is what the options market prices in. It strikes me as sellers getting trapped in the early morning trade after sweeping the prior day's low, not seeing follow through underneath Thursday for continuation to the downside. Shorts late to the party start to panic. What do? They cover. Nobody wants to hold shorts over the weekend as the market starts its ascent in the upward direction, and it leads to further short squeeze. We'll see this on the market internals in just a moment as well. So for the most part, this does not strike me as new money buyers. It still strikes me that a lower high is available in the daily trend count anywhere underneath 599.65. And the reason that that level is so important, not something like this 595.85, yes, it's still important. Don't get me wrong, it's still a key technical level. But this is the major one because we know, we just saw it based on the volume profile, everybody who participated, I shouldn't say everybody, but most participants based on the volume profile clearly show us that they have established positions over this level. That's the whole point of that weekly look. So after DeepSeek's gap down, a majority of participants enter above. After the tariff gap down, a majority of participants enter above. Even as we continue to extend the gain towards all-time highs, more participants are getting involved with terrible trade location, on the long side that is. So if those longs are going to close out for break even, what's the first opportunity that they have? It would be a retest of 599.65. So if this market gets a little bit of lift early on in the week, I would be looking for rejections around this area to keep the market bearish. That is the base case as we move forward. Lower highs to be established at 599.65. Now, I would love if the base case gets absolutely shattered. Why? Because I, like a majority of people, also have a long-term portfolio. I like it when the market moves in the upward direction. I don't want to be any more bearish than I actually have to be. So it would be fantastic if the market broke the base case immediately this week, started to push through 599.65, and found acceptance above that level. However, given a number of data points that we'll walk through today, I'm not sure that that is the highest probability outcome that we're dealing with. So to me, the daily is all about potential rejections around the daily 50 SMA, and notably at 599.65. If the market starts to put in a higher low above, I'm not going to argue with it. It's going to be what it's going to be, but the base case about flipping the daily trend back to down is going to go out the window. I would say it's very neutral at that point if the market's finding acceptance over the key level, in which case we can start to walk our upside levels to the upside. If the market pulls back first, if there is no rally attempt first, we've talked about this, upside happening first. Let's say that doesn't happen. Let's say that we open the week sort of here. Now it's going to become a game of how much acceptance is there underneath 590.25. We can see that it's the low of this move, it's the low of this tariff move, it's the low of the Tuesday sell-off, right? So if the market opens here, do we start to get acceptance under 590.25? In which case, that is just inherently bearish, right? So any movement underneath that probably seeks continuation of the daily breakdown into these lower levels, 580.475. Then beyond that, right, we're really targeting, the Friday low. And then we have this and this at 579.75 and 575.75. And we'll have to update you on Wednesday if we need levels beyond that. There's a sneaky one down there. It's way down here at 566.15. Don't want to be overly sort of like cautious or pessimistic, shall I say, and say it's in play this week, but it's the next major level. The daily 200 SMA is in here as well. So we've talked about downside. We've talked about how the sellers probably continue to retain more of their edge here in the market, so long as any rally attempts are met with resistance at 599.65, and so long as any opening drives to the downside this week seek lower highs underneath 590.25. Let's move to, actually, before we get to the hourly time frame chart, let's use the fibs here. I was having a wonderful conversation about fibs the other day, so let's just take a look. You can clearly see here that the 38.2 relative to this prior low and the all-time high aligns with our key level at 599.65, as well as the 61.8, I should put a box around it, aligns with our 590.25. I think that all this is doing is reinforcing that these are the appropriate levels to really pay the most attention to from the daily time scale as we head into this week. Another conversation to have is from the top to the bottom. And of course, you can see that if we're underneath the Fibonacci 38.2, we really can't consider this anything more than bearish consolidation for a bear flag, right? If we start to breach over, I would say, our 599.65 key technical level, the Fibonacci's are always secondary, the 61.8 is there, and I would start saying, okay, if we get this acceptance, any push over the 61.8 just generally increases the odds that we should be seeking a 100% retracement back up towards the all-time high as the reference point here. Final comment, I suppose, and I think that this is just, something we sort of hinted at on the weekly time frame chart. To me, it's more about the fact that after a multi-week, really multi-month consolidation here, the attempted break to all-time highs failing with such aggression. It's not just that the market came in a little bit off the highs and we're just noodling around in here. It's the fact that it happened with such aggression that is perhaps the most concerning to me. And what's concerning along with this as a supporting data point for the valid concern is the market has sold off what I would say is fairly aggressively relative to what we've seen in recent timeframes. However, we have not seen capitulation. I mean, look at the weekly performance of the sectors here. Half are green and half are red. The time to duck and cover and oh my God, the market's crashing going to zero is when there's no hiding, when everything is red as measured from the week's open. So, when I think of that, it's okay, if this is just the start of a stronger downside move where there is nowhere to hide, none of the sectors are getting rotation, and we'll talk about sectors as we move on, as we always do, but I think it complements the conversation we're having here. When that happens, that's we take out this low and all hell breaks loose, we fall into a weekly downtrend, right? That's when you're looking for that capitulation. That's when you say, okay, where's the monthly high or low as an opportunity to perhaps reposition longer-term accounts, add to longer-term accounts when and if we get to that capitulatory state, right? So anyhow, that firms that up. Let's move on down to the hourly time frame chart. This has been much more of a stream of conscious, conversation about the market as opposed to pure play analysis. So I appreciate you guys sticking with me. You can clearly see this level as being influential. If we remain below that on the hourly, of course, this is just bearish consolidation. This is the overhead supply level, our key daily at 599.65. You can see it was a perfect rejection on the Tuesday session, right? As we got that counter trend rally here, fading off. Really, so, not much to read into other than, of course, the hourly trend is down. First place to look for a lower high is actually before the daily key level, 595.85. Certainly seems like a rejection there. Should give us, at minimum, a retracement back down towards these lows at 590.25. Why do I say that? Because this is a thin structure break, right? And it was really emotionally driven buying happening into the end of the session. They're not really what we would consider new money participants getting involved in the market. So, of course, the most bearish outcome, let's acknowledge this as well. Like, let's try to remain as even-keeled as possible in this current condition. If this was really going to be bearish, this short squeeze probably shouldn't have happened, and you would have seen a rejection here at 590.25, which is why I was saying from the daily perspective, if we breach that with a lower high, that's probably where you have an actionable short, because now you're back down underneath this level. In a picture-perfect world, anyone who was short early on in the Friday session probably just wanted to see like lower highs here to persist the hourly downtrend. So the close back above maybe neutralizes things in the immediate term, but generally, as we've had this conversation today, seems as though the bears do have much more of that edge so long as price remains underneath 599.65. So Matt, how do we get involved if there is going to be a big bullish turn? All of this caution was useless, and oh my God, the market's ready to go print new all-time highs. If the market rallies to test this level, then produces a higher low, I would probably say anywhere over the 590.25. So let's just say that it looks like this. My first thought is, yeah, absolutely seeking shorts here. But if that short has to come to a conclusion at these levels and does not get continuation back down to the equal low, let's just say, let's take this off. We start to find a higher low here. This is where, of course, from a trend perspective, right, because patterns really just describe different trends, we would have to acknowledge the bullish inverted head and shoulders. And when and if we bring in a higher high over the neckline, ding, 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 the key level from the daily we were just talking about, that's where we fold the cards and say, hey, base case to the downside, trend continuing, market crash, probably off the table for now. Let's not overstay our welcome on the bear side. I think that conversation is one that needs to be had, very, very early as and if we see this pattern. One of the things that, this reminds me of is, again, this sort of stream of conscious about the market is it has not paid to overstay your welcome on the downside in any of these conditions. As soon as you see the first signs of a bullish reversal pattern, it has more so paid to be long the market, as we all know. And I think the classic example is, let's just go, we want the monthly time frame chart. Go out to a monthly. I mean, the classic saying, right, is that bears sound smart, but bulls actually make money. And I think that holds true. So we have these cautionary things that we can pay attention to. We can monitor the base case. And again, I think that in the short term, the bears might have a little bit of that edge here. But let's not forget that if the signs start to reverse, if we do see this develop as, let's even bring up the neckline a little higher. Let's say that we develop this as a daily inverted head and shoulders. Like, we will call that for what it is, and we will take advantage when the time is right. I just don't think the time is right as of right now, and I don't think that we have a fully formed reversal pattern in play yet. So those are my thoughts. Let's go back down to the hourly. Let me give you our intraday anchored view apps. And point being here is that there's two sets you probably want to care most about. This sort of supports the idea, so this is the all-time high, as well as the Friday session of 2 weeks ago. I would say that was really what kick-started the selling. Those two anchored view apps are sort of confluence right here for that potential rejection at 595.85. I suppose we didn't give you the clean pathing, so we'll do this as we're talking about the anchored view apps, right? If we get a rejection here, I would be trading for shorts, something along the lines of risk, reward to the downside, seeking a move into 590.25, and I would look for continuation on Brigade bullets below that level for something along these lines, or you could just ideally balloon runners into that next target. Then, from here, I certainly would expect the possibility of a counter trend move again, and if we were to see something along those lines, you could reestablish the same position. This one here is what I'm referencing. Now, the next breakdown, if we set a lower high and come back down into an equal low at 584.75, that's where I would want to be short through the breakdown, set a lower high underneath anywhere, and start seeking some of these further downside targets. That's what the shorts ultimately want to see, and these are the risk-reward ranges that I would try to exploit to the downside. If we catch ourselves for a higher low here, this is where I would want to see this unfold next. So there's two ways to trade this. If you want to try to make a stand here, and if you want to try risk reward back to the upside, ballooning runners to the daily key level, then absolutely, there's nothing wrong with that from a trading perspective. But when and if we approach this level, I would keep in mind that any major hourly double top that happens in this area, it could look like a double top, it could look like a head and shoulders, it could look like an inverted hammer. That is the place where I would say, okay, this is where it makes the most sense for a daily lower high to be set, and I would respect that on the first test. So am I overstaying my welcome on the long side? No. This is a continued counter trend move into 599.65. If the market holds this higher low, and then of course the pattern turns into what? It's the inverted head and shoulders we were just discussing, then over the neckline with acceptance. When I say with acceptance, we're really talking about a higher low over 599.65. That is where I change my tone. So are there upside scalps to be had for potential longs from, let's just say, point A to point B? Absolutely. As traders, that's like the beauty of being a trader, is that you can trade both directions here, and you don't have to be overly paralyzed by, oh my God, we're in a downtrend, I can only short things, or oh my God, I'm in an uptrend, I can only long things, right? If you take this flexible approach, there are going to be scalps to be had, but just understand that you want to participate as close as possible to the best trade location, which are these inflection points that we've identified here in today's video. That way, your stop is very reasonable. You stand to make, right? This is the whole premise of risk-reward trading. You stand to make far more than you're risking on the individual setup. And if you have any semblance of an edge, right, then you'll come out the other side with some profit. So that's the conversation. That's what we're dealing with here out of the S&P 500. I would say that obviously we want to continue monitoring the Friday anchored VWAP. If this slowly catches up and provides support like this throughout the week, let's just say that we rally first. If we get confluence here, it would reinforce the decision to try a trade along these lines. So we have this anchored. It's very, very early. It has not matured yet. We'll see how that develops into the week. We've been on quite a tirade about the S&P. Let's take a look at the S&P 500, or I should say the NYSE market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Let's primarily focus on what was going on Friday end of day. Why do I believe that this is a short squeeze only? Well, normally, if market participants, let's say, we call them the OTF, the other time frame participants, not traders, people who have, we're talking hedge funds, pension funds, anybody with serious capital who has like a mandate to be involved in the markets, XYZ. Those people do not just emotionally make a decision to buy the market in the last, couple of hours of the session. This is not what new money buyers typically look like. So although, yes, we have volume flows, what was the market doing earlier in the day? I would say it hardly looks like accumulation. This is really more so neutral than anything else. If you look at the advanced decline line, it rallied, faded to zero, and then it sort of came in here. A day where new money buyers are actively sitting in the market trying to drive, I shouldn't even say trying to drive prices higher. That's not their motive. Their motive is to establish a position. Then you'll see the advanced decline line in trend higher zone. We will be over the previous day's settlement across the NYSE. It wasn't the case. The index score is much more of an intraday tool, so of course it's going to end strong here. As we look at the cumulative tick as well, the morning tries to make a stand. Again, this does not seem like new money buyers to me because it quickly fades. And then what do we have here under the open? You actually fade to negative out of the cumulative tick. So on Friday, my point and the whole point of looking at the internals dashboard is to sort of confirm that, yeah, this is not JP Morgan filling orders for their clients who are calling them up and saying, hey, buy the market here, buy the market here. I want to invest for the next 10 years. That's not what's going on as of Friday's close. If it ends up turning into a stronger bottom over time, then don't get me wrong. Those clients will establish positions and they will be A-okay as soon as and I'm not saying, please, I'm not as stupid as I might sound here. I'm not saying JP Morgan's going to take the trade brigade strategy and reestablish a position here. It's not what I'm saying. What I'm saying is once a more defined bottom is put into place, that's where the smart money really starts to get involved. They're not nailing tops. They're not nailing bottoms. People who generally are participating on the 10-year time scale, honestly, I would say people on a 10-year time scale are hardly even thinking about this. And you can debate me in the comment section. You could say, oh, I'm on the 10-year time scale and I sold at the tippity top. Well, great for you. I hope you're rich, right? And go retire, relax, live your life, and enjoy it, right? So if you can nail tops and if you can nail bottoms, kudos to you. You shouldn't even be watching this video. Just, go enjoy life on a beach somewhere if that's your motive, or continue working on your passion projects. Now we're getting totally derailed from analysis. Point being, as I take a deep breath, these are not new money buyers. And the other thing that I can say to support this claim is taking a look at the market profile. We can see the same thing. Let's give this a little refresh. Let's give the platform what it wants. As we take a look at this, we have an M period spike. where there's hardly any volume committed at price here. New money buyers get involved, tagging VWAP, sitting on that sort of bid, saying like, hey, come fill me down here. Okay, thanks, we beat VWAP. Hey, fill me down. Okay, great, we beat the VWAP again. That's how new money buyers get filled. They're not panicking and saying, oh my God, let's buy this into the close to end out the February month. This is like, especially from a market profile perspective, single prints like this are totally emotional, totally short squeeze, right? You can see anybody who was short earlier on in the session as the market was just grinding around sideways down there, squeezed out into the afternoon. But generally, the value area in the point of control was left lower in the overall session. It did not migrate higher with price. So is there truly acceptance up here? No, I would just say shorts late to the party got screwed. Anybody who was short underneath, like again, just put yourself in the shoes of a trader. You're short underneath Thursday's low. Okay, look, we're going lower. We're underneath Thursday's low. It's going to crash. Nope. We're spent all day going sideways, doing nothing. Ooh, I don't know if I want to hold this short over the weekend. What if there's some positive news from tariffs? What if there's some negative news from tariffs, but the market reacts positively? And what if this? What if that? All right, let's just close out of short positions. What does that do? It adds buying pressure to the market. So totally on a tangent in this weekend's episode of the weekly watch list. You can let me know in the comments section if you enjoy this type of commentary, or if you prefer the straight up, like, these are the key levels, these are my thoughts, and moving along without the sidebar commentary. Let me know in the comments section as well. I love, having this conversation. However, if it's not valuable to you guys, I'll keep it to myself. It'll be an inner dialogue, and that'll be that. I didn't mention, but you can check out the video tutorial on the market profile in the top right-hand corner if you are interested in that. Let's move back on over to the Thinkorswim platform here, and let's take a look now through the QQQ NASDAQ 100 cash ETF. Let's do the top-down deal from the monthly perspective, and we will take a look at the clean drawing set here. I think, we get the same gist of the dot-com bubble bursting and the great financial crisis. We needed a monthly downtrend. Nothing has changed with that. If we take a look at the monthly structure here, of course, it's a little different than the S&P 500, and that's because tech has been, more so brutalized than the more well-rounded S&P 500, which tech is just a component of. But nonetheless, bearish inverted hammer with a red bar, so therefore there was that close underneath the opening print. This is more bearish. We have more of a broadening formation with the higher high and the lower low on the bar-to-bar count here, and we are coming into this level, this area in here, and I would be mostly interested in the reaction off of this level. I would think that if the monthly is going to break down, a monthly higher low can still persist close to this 450 level. And again, there's short opportunities to be had there, absolutely, but the monthly trend won't really be in jeopardy if that pullback does take place. So 450 is the pullback low there. Let's just quickly check in on the fibs from the bottom up to the top. This is, of course, above the 38.2, so no issues from that point of view. What if we come in from here? Because this is a little bit more exaggerated than the S&P. The 38.2 from this is certainly above by about 15 points there. So that's a little bit, it would be ideal if we stayed over this 38.2 and we did not have a full retest of the 450 zone down here. These previous sets of highs potentially acting as resistance. Are we at the measured move? I would think that the answer is, of course, not quite, depending on your measurement. Oh, yes, we are actually. Wow, look at that. This just goes to show that I'm much more in tune with that S&P 500 versus the NASDAQ 100. Let's take a look at the monthly measured move, because I didn't think, we weren't really considering this a bull flag in the first place. Yeah, we're through that. Reason we weren't considering that a bull flag, for anybody who's curious, now that I've said the comment, I feel the need to justify it, is because it technically went all the way to the 61.8. It's technically still a nice hold of a fib level, but bull flags to me are over a 30% or, roughly 30%, 38.2 fib retracement. Anyhow, that's the justification, and we are, I suppose, extended through those measured move targets, so all set from that point of view. Let's take it on down. So I guess final comment on the monthly is sitting at the highest high, bearish inverted hammer, lower low, close inside the previous month's range. It seems to me that the key area that would need to break is just the February low, which is very, very clean, because if we take a look at the weekly time frame chart, the low of February is almost spot on with the low from back here. A little bit of a breach, but the reason that this is such an important level, 500, is because if we do this, it's the previous all-time high. So in theory, and I've been saying this for quite a while now, even as this pullback was developing over here, as we were building out the very first stages of the weekly balance range, it's very difficult for me to take a bearish stance on the QQQ if we're technically remaining over this previous pivot high. Why would we want to be short into a potential area of support? And we've seen that, right, on Friday's session via the lower wick here. So candle structure and location, let's not deviate from the typical plan. We do have a solid red-bodied bar with a little bit of a lower wick. It's not as much of a hammer-esque style bar as the S&P. We do have the lower high as well as the lower low and a close completely outside of and underneath the previous week's range. If this is going to turn into a double top, we would need to break down through this area, which started to happen on that Friday session, but again, did not see follow through. We did not see a weekly close underneath 500. So let's take it on down to we can throw on the anchored VWAPs from the weekly perspective. You can see we're in the middle of the cluster there. So yes, supportive off the bottom end. Closing in the midpoint, these potentially can act as resistance moving forward. I would say the biggest thing on the weekly chart is if we set a lower high, that starts to become more concerning, right? Maybe we start to build out, I haven't said this one in a while, a little bit of a man ray pattern with that double top with the right and left shoulders as well. So we'll be on the lookout for that. But really, I think keeping it simple here is going to be the best outcome is 500. Right? We're either over or under 500, and that will sort of dictate whether or not on the higher time frames we remain, we could stay neutral in this box. Maybe we're not as bullish as we once were up here, but we're not bearish. We'll put it that way from the weekly perspective. We checked in on fibs from the monthly, but we did not on the weekly. Here we go. Oops, let's get the click. There we go. Right off of the fib 38.2. Love to see it. That is making sense here on the weekly, and I would say that probably maintains more of that bullish stance as we've already noted. Of course, this aligns with the prior level if we come in from the November lows up to the highs, right off of none of them, but we did close over the 61.8, which I suppose, remember that the whole point of the 61.8 closures are the more bars we spend underneath, the more likely it is you get the 100% retracement. So the fact that we've closed above maybe leans into that neutral data point a little bit more so. Bottom line on the weekly is we'll keep it simple. We'll align with this 500 level. If we're above, I would say you have to maintain at least somewhat bit of a neutral stance here. And of course, like the tricky thing as well is depending on, again, your level of participation in the market, you honestly aren't wrong in terms of saying something like, I want risk reward like this back in the upward direction. So longs into the end of day on Friday off of this weekly key level, probably not a bad idea with very tight risk off of a key level. I would say that the only hesitation I have about this is that we are coming in off of a failed breakout. And usually it's first test, best test, second test. If it yields a lower high, you can probably scalp out of that. But if a lower high comes back down into the equal low, you can only knock on the door so many times before someone ultimately opens up. So I don't want to be more bearish than I have to. I know we're spending a lot of time talking through the commentary here this weekend's update, but 500, let's keep it simple on the weekly. Let's go to the daily time frame chart. Let's evaluate the weekly expected move here for the nasty NASDAQ. What do we see out of the gray shaded box this week? We have the upper bound at 522.45, a nasty lower high relative to the all-time high, and at the lower bound we have 493.75, implying a slightly lower low under the low of last week. Daily 200 SMA in green down here will meet us for potential confluence if we test that area. We also have a previous technical level at 492.50. 492.50 represents a gap close from the election push and euphoria to the upside. The key overhead supply level on your NASDAQ chart here should be a little bit more obvious versus what we were talking about over in the S&P 500. It's this, and we're right there as of Friday's afternoon rally into 510. If the NASDAQ rejects 510, sets a lower high, first and foremost, pattern-wise, bear flag consolidation. Secondly, trend count-wise, higher high, the highest high in the trend count, right on the breakout here. This could be construed as like a soft lower high in the trend count. This, because the hourly trend is trying to flip to up, certainly would suggest a lower high in the trend matrix, and we are seeking continuation to the downside if that holds. So 510 is your line in the sand for the QQQ. If we get over 510 this week and find a higher low above, I would maintain a neutral stance through this zone in particular. So this, we're probably back to scalping back and forth. Be my guest, longs and shorts equally play. And if I'm really going to change my tone to the bull side, you have to show me the love over 522, over the daily 50 SMA. If we can get over that, and keep in mind that's the upper edge of the weekly expected move, if we can get over that, I would say all of these shorts start to become too trapped, and there was no successful breakdown through the bottom end of the range. In here, I would say, okay, maybe we just persist, and then we go back to the conversation of saying, okay, a little bit more bullish up here with the potential for a failed breakdown. The sellers didn't get follow through, but let's acknowledge that the buyers also didn't get follow through. We're trying to take that even keeled approach. We're not leaning one way or another. It starts to suggest, okay, buyers might get another attempt at it, but let's make sure that it actually finds price acceptance above with a higher low before we start rooting and rallying for a big upside move. So those are the two key inflection points on the daily. 522, which is hidden here at the upper edge of the weekly expected move, and the daily 50 SMA. And then the Tuesday, Wednesday lows at 510, which represents the bottom end of the overhead supply. Continuing along with the Fibonacci's from the daily perspective, that way we're not too crowded on the hourly, you'll notice that the 510 level is under the 38.2. I typically always favor the technical levels before the fib, so to me, this just makes total sense as confirming as bearish consolidation for a bear flag, and I would think that this 61.8 is fairly close to our back on the bull side level of the market, which if we get acceptance above, maybe we see the rotation to the upside. So those two key areas loosely reinforced by the fibs, nothing major there. Let's go down to the hourly time frame chart here. One of the things I think that we sort of did not describe in as much detail on the S&P chart that's probably worth talking about is the fact that there is really the best opportunity for trend neutralization on the Thursday session. I say that because if you look here, of course, the pattern that could have been in force was a potential double bottom, even a higher low double bottom. You have to keep in mind that on Thursday, the market opened up here. So from here to here, Wednesday afternoon, this is Tuesday, right, to Wednesday afternoon, we have a potential higher low on the hourly. If there was going to be a break through the neckline, it should have been on Thursday's open. We open here, close to the neckline, all it would have taken, and not to say, obviously this 522 still would have been a huge roadblock for price, but there should have been, if the buyers were active in the market, if people were stepping up saying, hey, we want to buy this market, this higher low should have stuck. We should have tried to at least attempt a higher high. That's just not the case at all as to what happened on that Thursday session. We, of course, broke to the downside, consolidated, and saw extension on the Thursday afternoon session there. So really not seeing the evidence of stronger buyers. Should have tried to take opportunity when it presented itself, the bullish opportunity when it presented itself to neutralize the trend. Just didn't happen. So instead, right, all failed patterns turn into a different pattern. Instead of a double bottom, it is a bear flag underneath the low. Sayonara, nice new lower lows are brought in. Let's check in on our intraday anchored VWAPs. And we can see over here that we do have the all-time high / Friday's ignition, if you will, to the downside, anchored VWAP coming in. And over time, it's not going to be quite on Monday, but maybe something like Tuesday, depending on where price goes on Monday, these will provide some confluence of resistance off of this level at 510. Prior support now acts as resistance, and the retracement should be back down towards the equal low at the weekly key level 500. Here's the deal. If 500 is tested, right, after sort of one of these guys, I would be expecting that the bears are in the driver's seat, and the first order of business is seeking a breakdown there. 500 starts to violate the weekly key level. We would start to sound the alarm that, okay, something more bearish is apparently taking place. If the market gets down to 500, catches support, never breaks through. That's the key here, never breaks through. And this is the double bottom, then fine, over time, this turns into an inverted Man Ray pattern. And now, once the market starts to act constructively with higher lows back over 510 after an equal low, this is where we change our tone on a higher low to the upside. So that's sort of how I'm envisioning the trade going. Not this path in particular, but those are the concepts that I'll be thinking about as the week wears on here, headed into a number of economic data points, as well as just like general tenseness around the market, right? Maybe you've seen this online or maybe you haven't, but the AAII, bull bear sentiment is at like levels we have not seen in a very long time. Everybody is majorly bearish down here on the lows, hardly off the all-time highs by like 5%. So if there is going to be a whipsaw, I think it's got to be constructive off of something that looks like this. The only trouble with that, right, is if it's going to be a short squeeze that just totally explodes to the upside, we're gonna see the explosion to the upside. It's going to be very difficult to participate in. Anyone who's swinging long from that weekly point of view, this is just to sort of have that full conversation about the NASDAQ, right? And to go full circle with it. Anybody who's willing to take the risk reward here, trading to the upside, will be rewarded if there's a rip your face off, oh my God, short squeeze, everybody's burnt on the short side, right? The trouble with that is, right, there's just no evidence of that as of right now. There's no evidence of new money buyers really stepping in here in the shorter time frame. So to me, I'll be watching for the trend following, the trend count, trade ideas, everything off the key levels, We're going to do the status quo, and that'll be that. But just understand, if this does see a rip your face off, just consolidation up here might make this such that it's very difficult to participate in the A to B move on the first go around unless you're already long, which requires, you've got to sort of pony up. You've got to put some risk on the table if you're taking that trade. So that's the long-winded conversation about the NASDAQ. We know the up and down levels. We know that under 500, excuse me, we have 492.50, 484 down here. I know you guys maybe come here for a little bit more of a definitive, like, okay, what's the game plan, right? My first thought, and what I'll be looking for early on in the week, Monday, if we open under 510, I would prefer shorts back down to the equal low. I'd be looking for a lower high to be set underneath a very obvious and key technical level. If we open over 510, I will watch out for a gap fill reversal, and I would be open-minded to some firmer counter trend moves, possibly further short squeeze. So 510 is the first level. Do we open above or do we open below? If we get this to the downside, I've already described how underneath 500 the door opens from the weekly perspective. I think worse things continue for the market there underneath 500. That's a very dangerous level. If the market sort of double bottoms here and does not, again, looks like this, I'm not fond of entering the double bottom here. I'm much more fond of entering over the neckline when the chart actually looks something like this. That would be over 510, risk, and then reward back to the upside, something along those lines. I totally get that opening the position here and then trading for the same outcome gives you far more reward on the upside. I'm not stupid. I didn't fall off the turnip truck yesterday. But this added layer of confirmation is something that I actually prefer in my trading versus trying to buy this at the double bottom low. So anyhow, those are my thoughts. That's sort of like my bottom line, what I'll be looking for earlier on in the week. Hopefully that maybe helps someone who's like, just get to the point already. Let's take a look at the NASDAQ internals. And again, I'd love some feedback in the comments below. Sometimes I love having this conversation, but I can totally understand if it's not all that useful. And it does extend the length of the video quite a bit, especially when we have monthly charts to cover. Volume flows, same comment as the S&P 500. We had a negative advanced decline line here instead of staying over the zero mark into the afternoon on the S&P, so a little bit more bearish over here, and the cumulative build stays bearish into the close out of the Friday end of day rally. Again, this to me looks nothing more than short squeeze. It does not look like new money buyers actually participating in the trend. If we take a look at the NQ market profile, M period, there is your spike. So we didn't talk about it over on the S&P 500, but spike rules will absolutely be in play for the Monday session. And the spike rules simply state you're going to want to watch and you're going to want to mark the M period high and the M period low. This is about 20,800 in the NQ futures. I'll go back and give you the ES level in just a moment. You could probably spot this on your technical candle charts anyways. But if we open in the spike range, then fine. We just look for reactions and we wait patiently until we either test the spike high, or the spike low. If we open over the spike high, in theory, it should keep the short squeeze on, right? And this is the same thing as talking about that gap up over 510 we just talked about in the QQQ cash candle chart, right? And why this is the case is because, the market only stopped auctioning higher because the bell rang at 4 o'clock. So we don't know if these prices are fair or not. The market may have continued the auction to the upside. So if we open on a gap up, gap fill reversal gets very important here to stay over the spike high. If we open under the spike, this is the most bearish outcome here. And of course, what the sellers want to see is, short squeeze validated. These are not new money buyers. And shorts will continue to pile on down here, potentially looking for further downside as and if we reject these higher prices. So over, in, or under the spike will be influential. It'll be like the first major data point that you're going to want to watch for on the Monday session. So watching that closely here out of the NQ, we could take a look at the ES futures, the base of the spike closer to 59.25, and of course the high of day representing the top. And the spike rules are the same, opening in the spike, looking for a response here, looking for a response here off the bottom end. If we open on a gap up, gap fill reversal, keeps the short squeeze on. If we open under the spike base, 59.25, this invalidates any of this price action in the upward direction, and we would expect further downside should that be the case. So there is your look through the big two market indices. Let's take a look at not the younger brother, because of course this is like the broadest measure. We could talk Wilshire 5,000, 6,000 someday, but for now, let's stick to the IWM, the Russell 2000. Let's take a look at small caps on the monthly perspective, and this has acted divergent for a very long while now. Let's even zoom out to a multi-year, like a 15-year chart. Point being is this high technically made a new all-time high, and there was an aggressive breakdown, right? You could even do something that looks like this. There's an aggressive breakdown back underneath this breakout point. And the monthly, excuse me, not weekly, the monthly bar here is not compelling by any stretch of the imagination for further upside. I mean, this is a bearish inverted hammer with a red-bodied bar. Sellers clearly made progress in the downward direction, expanded range underneath the previous month's low, closed right at the previous month's low. It looks bearish. To me, it looks more like a left, a head, and a right shoulder is building out. We've even been talking about this from the weekly perspective. So the major target here would be the monthly 50 SMA and the top end of this multi-year balance range at 200. Is it possible that the monthly can maybe make an equal low around that spot? It's possible, and we are technically coming from the highest high in the monthly trend count. I wouldn't really call this a monthly lower high just yet, but really not helping the case for an S&P 500 continuation move into blue sky territory. So that is noteworthy here out of the IWM 2000, Russell 2000. Let's take a look at the fibs. There's your 38.2. We're right at it. I would say that the breach of that area should just bring in like the next reference point, the 50 SMA in the top end of the range. So watching that quite closely, and for the most part, I think that's it. That's it on the monthly. There's not much else to go over here. Let's go to the weekly, and now we can really start to see that very clear left head, right shoulder. Depending on how you want to draw in the neckline, I've been using this trend line, which was kind of mirroring the 50 SMA. We're clearly underneath that at that point, and if you want to just use a horizontal level, we looked underneath and we've closed right on it. I mean, what have we seen? The look above and close right on again. It's at the top of the shoulders, right? We saw the look above, closed right on, opened and closed hardly below. I'm not saying it has to resolve. It's the only possibility to the downside, but it certainly seems more of a susceptible area for further breakdown than anything else here out of the IWM. So small cap continuation seems, I don't want to say imminent because there's nothing imminent ever in the market. The market always does whatever the market wants to do, and we just react off of our reference points. But it doesn't really look like a compelling argument here to be long, especially after that very clear now weekly lower high. I would absolutely call this a weekly lower high, not a monthly yet though. So that's what we have here. Let's take a look at our small caps anchored view app cluster, all above, acting as a potential another lower high on the weekly. So that's of course concerning. If this target happens to the downside, it's not quite at 200. It's actually in the midpoint there. So that would be the first target before reaching the monthly target of 200 and the top end of the prior monthly balance. All set from that point of view. Let's quickly grab the fibs from here to here. Closed right at the 61.8. Remember what we say, the more closes we get under the 61.8, the more likely it is you see that 100% retracement. Small caps really not performing well, as we've sort of tied in the narrative over the last couple of videos, is pretty compelling as a case because small caps are very sensitive to the economic data and the fundamental situation that we get from the good old Fed. And the Fed tracker tool has been suggesting over the last couple of sessions that we're actually in store for 2 rate cuts in 2025. The odds are increasing for both rate cuts taking place. So you would think, great, rates are coming down. Operating conditions are getting easier for small caps. Those companies that struggle to become profitable when rates are high should start becoming a little bit easier. The fact that as rates are aggressively coming down, I'm jumping around a little bit today, but this narrative really needs to make sense here relative to smalls, right? Look at the 10-year breaking down as aggressively as we've seen in a very long time. Look at the gap down in continuation here. That should be a sign that small caps should get some love. As a comparison, take a look at this environment. So let's just say from like May of last year to September, right? So this move in here, as rates are coming down aggressively, right? Typically, we associate that with good times for small caps, and that's absolutely the case. So rates coming down hard and fast now this time, associated with large, really precipitous drops out of smalls, doesn't add up. And as we've been saying, and this is sort of the next phase of the conversation, definitely more indicative there of the recession theme than anything else. This is not like, hey, everything's going well and small caps are a tailwind for the market and rates are going to come down and the Fed's out of the woods and inflation's not an issue and the labor market's strong. That's not the conversation that we're having anymore as these things remain, not divergent. In theory, the reaction, the expected reaction is divergent, but, they're certainly moving in the same direction as of now. So anyhow, daily chart, IWM small caps, now that we understand what this is sort of signaling to us, it's saying, hey, this is like not good from a fundamental point of view. It looks bearish for the market. What do we have from the daily, or I should say weekly expected move plotted to the daily chart? 220.94 on the upside and 208.27 on the downside. Technically a lower high underneath the New Balance range, happening from here to here. And we also have the forecasted lower low relative to last week's low, which keeps us underneath the neckline of the weekly head and shoulders. So bearish, no matter how you slice it here. If you'd look for a counter trend move, I mean, the first place where a major lower high could be set, 218. If we go further than that, I would start keeping an open mind to lower highs here underneath 223.25. That's through the upper edge of the weekly expected move. The only way I could, maybe envision this being a high probability outcome is if the economic data comes in way better than the expectation here. And considering the conversation we just had about rates falling off of a cliff with the small caps falling off of a cliff, we are now in a regime where you want to see good news act as good news for the market. It's no longer that backwards, like, hey, if the labor market's actually struggling a little bit, that's bad news, but it's going to be good for the market because it means Jerome Powell is going to cut rates sooner than later. We're not at that point anymore. We're at the point where bad news spells trouble, and we want to see good news dig us out of this hole. So that's my take on smalls. Those are the levels, and that's really what we're watching here. Let's take a look at the hourly time frame chart. In terms of the pattern and structure that's in play, again, lower highs off of 218 make a lot of logical sense. I would say if we catch for a higher low after this, something along those lines, please be open-minded to further counter-trend movement towards that 225 zone we were just describing on good news as a catalyst to get there. If we do see this and then the lower high here, I would want to be short off of this level, targeting the equal low and then ballooning runners to the downside. You guys know me. I actually don't trade the IWM. I don't trade small caps, but I use them as a bull or bear head and tailwind for the S&P 500. So you could trade those levels, that's fine, but given the pathing that we just sort of outlined, if we see this, then intra-week, I'll have to say tailwind, bullish, for the S&P 500. If we see this, then I'll have to say headwind, and I'm looking for that more aggressive short to play for follow-through out of the S&P 500. Okay, so that's that. Let's quickly check in on the intraday anchored VWAP. You can see the cluster is underneath the 218, so even if there is a rally, you might get an arbitrary lower high. It might not look arbitrary in hindsight if it is the anchored VWAPs here. Let's take a brief glance at the Fibonacci's from the top to the bottom. And the 38.2 could be actually confluence for, again, what I've dubbed as an arbitrary lower high. It might not be so arbitrary if we come up shy of 218 and then see further downside. If there's a stronger upside move, again, acceptance over 218, and please just be open-minded for the possibility of upside. It's still counter trend. I think that at the end of the day, through the analysis we've conducted so far, we are sort of talking about that cautious bearish stance. We've certainly acknowledged more downside pathing than we have as the market's remained in an uptrend. Remember, coming from the lowest low in the trend count, this is a counter trend move. Let's not be blindsided by a move in the upward direction and start saying, okay, that's it, we're out of the woods, market's fine, all-time highs, right? It's a counter trend move until proven otherwise. So that's the commentary. Let's move along to the Rusty Russell internals, and let's see what we see here. Not even close to substantial volume inflows on the Friday end of day push. This is not near trend higher zone, and the cumulative build closes out red as well. So, I mean, just a rinse and repeat of all the commentary so far, which suggests that it was a short squeeze more so than anything else. Notice that on the Thursday session, value and point of control are smack on the lows of the session, and on Friday, point of control is smack on the highs of the session, but generally value is unchanged. It's more so sideways than anything else. That to me is noteworthy, which just suggests that, like, if you're going to see a stronger, like, new money buyers are getting here, you're going to want to start seeing value area progressing in the upward direction aggressively, not just like overlapping to sideways. So not really convinced that we have new money buyers stepping up in the market just yet. I think that, as we've described through the entirety of the analysis so far, this is a counter trend move until proven otherwise. Let's take a look through the sectors and see what's going on from this point of view. We'll try to speed up through the remainder of the analysis. I sometimes say this and then never do it, so let's actively make an effort to do so. Weekly performance of the sectors indicates rotation, and we talked about this in the Friday morning pre-market prep episode. So rotation is going to keep the market alive. This means that if you're looking for longs, you want to look at the S&P 500. There's more sectors here for money to flow into, unlike the nasty NASDAQ. The NASDAQ being more so concentrated to tech, there's nowhere to hide. So looking for longs, probably S&P 500. Looking for shorts makes a little bit more sense to be in the NQ. That's the rotation aspect. The other aspect, which we made note of earlier on in the episode, is simply that because this is representative of rotation, and because we haven't seen capitulation, which comes from correlation, this sell side is like, this could like hardly be the start of it. So that's a bit more of a concerning approach to analyzing what's happening here with the sector posture. If we actually look at the postures and what's performing well, what's performing poorly, I mean, bonds not being a sector, but undoubtedly doing the best on the week, that is a flight to safety style move. We'll look at the ratio in a moment. That's risk off. Financials did well. Financials are back as being the backbone for the S&P 500, trading back up towards all-time highs as of Friday's close. You're not going to have an outright market crash capitulation 2008 style great financial crisis if financials are trading at the all-time high as the second heaviest weight sector of the S&P 500. So again, two takes here. If you want to be long, you want to see financials break out and continue to carry the weight here. If you want to be short, you want everything to start selling off. You don't want to see weeks that look like this for financials. Break the low end of the flag. Start setting weekly lower highs, right? So that's that. Real estate's lightweight. It's a little bit more defensive. Healthcare is heavyweight. That is defensive. Staples are defensive here. Industrials, not really, overly defensive or risk on. At the bottom end of the barrel, semiconductors getting absolutely obliterated, down 7.37%. Of course, on NVIDIA's big old flop on Thursday after earnings. The technology sector, Microsoft breaking down aggressively. Apple no longer being that relative strength safe haven. And then even like communications and where's discretionary. A little surprised discretionary wasn't down more considering what's going on with Tesla and Amazon, but these are the heaviest weight risk on sectors and they're not performing well by any stretch of the imagination. As we quickly rip through these charts, here's the TLT. We talked about the trendline break not too long ago. We've gotten that break, and of course, this flight to safety, in my view, is sort of what's pressuring rates in the downward direction. So as small caps move lower and bonds move higher, this entire relationship is sort of screaming risk off. I'm going to say OFF because O could just stand for on as well. Risk off is what bonds are screaming as we come into here. Now, is it reasonable that bonds might pull back off of this technical level? That's a possibility, but a higher low that's set here, I mean, not to extrapolate too much, but there's your massive inverted head and shoulders after the micro inverted head and shoulders from down here. A stronger reversal out of bonds certainly seems like money is coming out of equities into bonds as a safe haven asset. We'll talk about gold as well in just a moment because I think gold could act as a signal for this upcoming week. Here's financials closing at all-time highs, basically. Is the market going to collapse while financials look like this? The answer is no. I had much more concern on the Tuesday session. The fact that this breached the low end of the flag and is back up here looks pretty compelling, I would say, for one of these guys to just have the S&P maybe produce more of that stronger counter trend move. The time where this actually becomes like, okay, let's start actioning to the upside and changing our tone from cautiously bearish back to bullish is if the technology sector can rebound, or I shouldn't even say rebound because it's under right now, if it can get back into its consolidation channel and also make a move to the top end of the range as financials are bringing in new all-time highs. So let's try to get there as fast as possible. Real estate, nothing to really talk about here. It's a really lightweight sector. Let's move along. I think that the case here for healthcare is more compelling. This is the fourth heaviest weight sector by market cap. Over this, again, the S&P is not going to see an outright crash if healthcare is seeing a move to the upside. Based on the pattern, based on this higher low set here, it does look like money's flowing back into healthcare. And as we look through the fundamentals, this will align as well in just a moment, both the financial take as well as the healthcare take. We're going to take a look through the FactSet earnings report, and you'll see that there's actually quite a bit of revenue increase out of healthcare and financials. Let's take a look at consumer staples. Again, rotation, plenty of room for consolidation or even a higher low from the weekly perspective here back over this level. If the market was going to crash and burn, there was no safe place, you would have just seen a lower high here. Simply not the case as of right now. Let's move along to industrials. Underneath this area certainly looks a little bit more concerning, I would say. Maybe massive weekly double top if we're under the neckline here. We could have said the same thing out of this and, of course, brought in more downside. So watching this zone in here, I would be more concerned if we make a new pivot low underneath this area. I would say that because this is no longer holding as a higher low, already the bears have a little bit more of an edge out of that one. Materials are the lightest weight sector we have, so not much to read into on that, but we should segue to the XHB, which is the home builders. A little bit of a counter trend move, and I hope that we properly sort of equipped you with this knowledge the other day. Yes, it was a counter trend move, but remember, making the new swing low technically means the lowest low in the trend count. Any lower highs can persist. Home builders have been saying like risk off for a while now, specifically out of this lower high back over here after the big Armageddon style breakdown through December. So this also sides with the cautiously bearish stance out of the S&P and the NASDAQ as well. That's home builders. Let's move along to where were we? Semiconductors are next up in the lineup. Underneath this, Another red flag to consider for the market if semis get a rejection underneath 237, the multi-month, this has just been such a painful range. The multi-month range has broken and has found acceptance if we get that lower high underneath 237. Now, this has a very poor track record of finding acceptance out of the range. We tested over here. This is 4 to the upside. You could say we had 1 to the downside, 2 to the downside. Is the third time the charm to the downside? Is yet to be seen, but at face value, this chart has to become more concerning. Aggressive breakdown away from the cluster of moving averages, away from the midpoint of the range, plenty of overhead supply. Anybody who wants out for break even sells 237, and we see a lower high be produced. That's a valid threat here to keep us on the bear side as we move forward. The XLK, same concept, but a wider range, right? This concept right here failed once, twice, 3 times, maybe 4th time is the charm. A lower high that's set under 226.85 seeks further continuation to the downside, and I would have to say that puts us on the bear side of the S&P 500. The comment I was making about the XLF, maybe pulling some of the weight here, is if financials break out through the top end of the flag and the XLK, notice the and statement there. It's not one or the other, it's both. If the XLK also does something that looks like this, we might have to change our tone back to the bullish stance on the S&P, but that's yet to be seen. My first thought looking at this chart is no, this is a bearish breakdown, and we will look for the validation of the bearish breakdown as long as price remains below 226.85. Moving along to communications, certainly a rejection back underneath this 102.70 keeps the bears in control for a lower high. We'll watch that. If we immediately get back above, a little bit more neutral here out of comms. Let's take a look at utilities. Not much to say over here. A new swing high would be upward pressure for the market. Discretionary made a obvious new lower high here, really Wednesday's upper wick there, right off of this double top neckline. Under 219.75 remains bearish for the S&P. I would like to see this come down, close the gap, test the daily 200 as we get Amazon and Tesla potentially trying to find a little bit more of a base. This to me seems like a stronger building point for a new potential reversal than just off of this low here. I would love to see this thin structure retraced, repair this, come on in for the stronger retest, and then give us a new base to build from. That would be a wish out of the XLY. Obviously, it implies further downside before seeking a more constructive move higher. Let's look at energy. Nothing to say in this. It's just inside a massive channel at this point. We'll talk about it when and if it breaches this range. Any insights from crude? Let's take a brief glance. CL, come on, load up here, think or swim. What do we have? A downtrend out of crude. We've been seeing crude back underneath the 70 handle, which acted as quite a bit of support back over here. So the longer it can spend underneath 70, I suppose, not that it's always correlated 1-to-1 with the XLE, but it would maybe imply some further downside here out of the energy sector. And we'll watch for inflation perhaps to ease as well on the volatile side. Obviously not part of core there. Let's jump on into the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This looks like risk off to me. This is still holding the S&P together. That aligns with the analysis we've conducted so far. This is not helping the case for anything. This is defensive. This is defensive, and this is defensive. Those are Ds, not Ps, specifically this one out of the XLP. Speaking of Ps, so defensive posture and risk-off posture seems to be taking a hold of the market currently. As we look at the specialized ratios, this does not look good. This does not look good. This does not look good here. This does not look good over here. Neither does this out of ARC relative to the S&P 500 in the short term. Huge failed breakout, and now going on to produce a new lower low underneath the consolidation low. That is another risk-off indication. And just to look at ARC in isolation maybe, to give some further context here, it's not just the ratio chart, it's also in the isolation. Over 63 was looking like, hey, this is a pretty solid move, looking for this to the upside. No hold here is strike one, no hold here is strike two. You absolutely shouldn't be bullish as that gives up. And now we've even gone on to produce a lower low. I don't know how you could remain bullish on this chart here. It seems like a big failed breakout to me, and the more time we spend underneath 60 going forward, the more we just have overhead supply for a risk lower high. That's risk off for the market. That is not a bullish indication for the S&P 500, never even mind the NASDAQ. Let's get back on over here. Let's take a look at some currency now. Let's move on over to the Dixie. Small move to the upside, and that certainly aligns with movement to the downside out of equities. And where's it happening? Right off of the top end of the range. Is it logical? Yes. Let's take a look at the good old gold, the yellow metal. This to me is interesting because what you can do is one of these guys, and your previous pivot high could potentially act as support. You got a little lower wick on the Friday session off of that level, and if you don't like the gold futures, we could take a look at the GLD ETF. This tends to be obviously far more choppy, as you can clearly see from the price action. This is not all the way there yet. If you do get a further downside move, it's into let's call it 257.50. It looks like Thinkorswim cooperated and gave us the round number. Thank you to Thinkorswim. If we can get the move here, then great. But out of the futures, which for me, I would tend to think, let's try to establish a GC position. Not, gold has always been very, very hard. The GLD ETF to actually squeak out anything meaningful from. So, maybe a GC contract here wouldn't hurt with a tight stop underneath the prior week's low, looking for the equal high up here. It's a possibility. As we look at the ratio chart, it's certainly still suggesting it's in an uptrend. We were sort of looking at a potential rejection off of these equal highs. The fact that it's gone on to produce a higher high means that, of course, this pullback, although it's technically back underneath this level, really is not concerning. There's still the opportunity for a higher low. That's a terrible trend line, but you get the idea. Higher low continues to look more risk off here as people go into a flight to safety, safe haven like the yellow metal. Let's move along to interest rates and see what's going on with TNX. We talked about it briefly, coming in aggressively here. I would just take a look at the weekly chart as a reminder to sort of say, like, okay, we've got this. Where's it like, okay, something dramatic is happening and the Fed's really responding to, like, rates need to go to zero now, there's an emergency underneath these lows. If you start seeing rates in the threes on the 10-year, some sort of like 3% yield on rates, okay, problem. Like, major recessions probably on our doorstep at that point. If it's like, whoa, cut those rates aggressively, right? And the market's going to do the job of the Fed pricing that in. Remember, you can't, when it comes to downside, at least, Jerome Powell is not going to come out and he's not going to say, like, yeah, we're pretty concerned about a recession. We want to ease up on rates here over the next little bit. As soon as he says that, what's the market going to do? The S&P is going to tank, rates are going to fall to zero, and like he will have caused the reset. So he's not going to say that, right? Regardless of what's going on with the conditions, it's just not going to happen. So read between the lines here. If, this continues to, let's say it's down here, something aggressively bad, systemic is taking place, and we can actually just jump on over to the Fed tracker tool right now and have ourselves a look for, ourselves. Let's see, 93% odds of the pause, with further odds shifting to the cut side instead of the hike side. And you'll also notice, and this is the main point of conversation, cut number 1, cut number 2, and notice here's the cutoff for 2025. I mean, in the beginning of the year, I'm talking about early January, we were like, okay, maybe there's just going to be one cut here into the end of 2025. Now we're pricing in 2, and look at the time scale of these things. I remember just, not even a week ago, it was like, okay, where's the first cut? Is it going to be in the July timeframe, or is it going to be in September? Which one is it going to be? For the first cut, not the second, right? So this, paired with the IWM analysis so far, takes us on that journey of talking about a recession, of course. Let's move along into some comparisons. This is what we had prior to PCE. And all I want to do here is just point out the probability change, right? The probabilities actually shifted this way for a cut. Not that we're expecting a cut in the March meeting, but in terms of the market's perception of like how aggressive we should be thinking about this stuff, everything got much more dovish from the Fed tracker tool perspective after PCE came in. As we take a look at PCE, you can see over here, there was subtle improvement, but nothing major. PCE on the month over month coming in hotter than prior, but at the expectation. And there was improvement here out of the year over year non-core, moving away from the 2.6 figure, and then on the core, 2.6 relative to the prior 2.9. Again, at expectations, which is what we typically expect from PCE anyhow, because it's a combination of CPI, which we get earlier in the month, as well as PPI. The market can make a pretty good forecast as to what PCE is going to be based on these two numbers. Point being is we came in sort of like at expectations, but we are moving in the right direction. The only thing that would sort of be concerning here is if there was a dramatic change in this upcoming month's report of CPI. If inflation, and if I just go on over to the calendar now, this is the coming week's worth of trade, and then as we go out one more, so this is 2 weeks out, not this upcoming week, but the week after that, CPI here. If this comes in hotter than the expectation, now we have to go from just talking about a recession, we have to start talking about stagflation, where inflation sees an uptick, and again, we'll only know that based on the CPI prints over here, with the combination of no growth, right? And that is like, oh my God, market's going to duck and cover ugly, 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 ugly. Not trying to be overly an alarmist. We will wait and see for the information. So far, as we just maybe go back here, let's take a look at the chart of PCE, right? This is month over month. I want the year over year. Show you guys that one. Let's take a look at this. Year over year, let's go to a 5-year, right? We've come down aggressively, and we're starting to roll over from this, what looked like a concerning uptrend. So this is a good move that we got out of PCE on Friday, but anything that sort of gets us back into range, an equal high over here, suggesting that we're flatlining on inflation, that's the panic mode. And again, this is not this upcoming week, but the week after that. I think it's relevant, to the conversation, though. Let's close this up. Let's take a look at what's on tap for this week, though. What we've seen out of services PMIs, and it was primarily the S&P Global report. We're going to get the ISM, which is typically the more important one, I believe, on March 5th. We saw a miss, huge miss out of the forecast on services PMIs. If that's the case here, this is the slowdown that the market's worried about. This is an all eyes on event. If services PMIs slow down again, remember the read was actually underneath 50. I think it was 49.6. Don't quote me on it exactly, but regardless, it represented a contraction. We probably want to see a read that's like, if you don't want to be inflationary, you want the components, prices paid and new orders, to be convergent, moving in the same direction. You don't want them to be divergent, where you have prices paid and new orders down. That's inflationary, of course. But we also want to see like sustained expansion here. We don't want to see any more growth concerns out of services PMI. So watching that closely. Manufacturing PMI earlier on in the week. The economy is not really a manufacturing economy anymore. So services are sort of more so where we'll see the direct impact and the market freak out a bit. So watching that. ADP non-farm will be our preview to, of course, Friday. Jobless claims on the Thursday session. What's really odd is they've bumped out JOLTS to the following week, which I don't entirely understand, but we'll let that be. The full Monty labor report comes out on the Friday session. Watching for hourly earnings, wage price spiral, NFP, as well as the unemployment rate. We are seeing some anecdotal headlines, right? If you just take a look at unemployment claims here, right, we've seen some anecdotal headlines finally starting to be reflected in the data. Layoff here, layoff there, and like now it's finally, government obviously is a huge component of this too. So this big uptick is worth paying attention to. Obviously, this is a report from the February timeframe, so we're not going to. This is going to be February's report. Last week's report will show up in the data. So watching that closely, and that will be on Friday. So look out for a potential uptick here to something like a 4.1, a 4.2. I think the market can withstand a 4.1 or a 4.2, but anything beyond that starts to get a little bit hairy, and we probably trigger the SOM rule again if we're at like a 4.3, 4.4. Let's move along to the earnings insight. And what I was talking about earlier was, so first of all, I guess if we scroll up here, this might eat up more time than I'm ideally looking to show. Okay, here we go. So surprise percent earnings, financials, as well as healthcare did quite good. Obviously, there's a number of sectors in here as well, but remember that healthcare and financials were driving some of the gain as heavier weight sectors for the market in the upward direction. It's kind of concerning that consumer discretionary did well on an earnings percent surprise, but is kind of lagging in the grand scheme of things. You can see here in terms of revenue and direct numbers, right? You've got financials and healthcare at the top of the list, and then consumer discretionary a little bit lower. The slide I was on, though, as I go back to the downside over here, we want Q1 2025 because that's what's up next, is very important. This is guidance. We want not EPS revisions, growth. Here we go. So note, and the point is all of these have been revised to the downside. Specifically out of where I'm most concerned, consumer discretionary being the third heaviest weight sector for the S&P 500. That is a red flag. If you look at infotech, it's down slightly, healthcare down slightly, and financials are down a little bit more so coming in over here underneath, though, the S&P revision. So the backbones of the market, which have been holding things up, still not forecast to do all that well through Q1 of 2025. As we move down as well, the next thing I want to point out here, we're not worried about 26 yet. Where I want to go is right here. This is important because I think that this aligns with the monthly conversation we were having. And, bless you if you've made it to this point in this video, because I know it's a long one. But we were talking about the previous monthly pullback, the weekly downtrend that comprised the last monthly high or low. That's here. And what do you notice about Q1 of 2025? It's on this screen at least, it's the only other earnings move that we've seen in the downward direction. So if you want to align things from a fundamental and a technical perspective, look at this, a downtick from Q3 to Q4 of 2023. And the point is, just generally, a miss, not a miss, but a contraction of earnings instead of sustained growth. Contraction instead of sustained growth. Let's go back to the technical charts here for just a moment. Let's align Q3 of the previous year. Let's go back here. Let's go. I know this is way more than we need, but that's this. That is totally this right here. So when I talk about the possibility of a monthly higher low pullback after a weekly downtrend, obviously this is a weekly downtrend here, weekly highs, lower highs, lows, so on and so forth, obviously a daily downtrend as well. As we're talking about that, it almost, aligns with what the market's forecasting from a fundamental point of view. And, this is not to say it has to play out this way. It's the only possible outcome for the market. That's not really how that works, but it would seem to make sense. I wouldn't be surprised. My jaw wouldn't hit the desk and say, wow, I can't believe that just happened. Of course I could believe it happened. Something that I do find interesting as the 10-year is breaking down as well is just that the PE ratio is aggressively coming in. In theory, air quotes, valuations are being reassessed. That's one way to potentially frame that as the market is coming in. In terms of outstanding earnings reports, there's really nothing here that's like, there's some retail obsession that maybe NewScale, Hut 8, ASTS, what else? RGTI, quantum computing is maybe interesting. JD, from a China perspective there. I would say the biggest ones, the ones that are actually going to make a difference for the market, probably these guys up at the top of the list on Tuesday, Target and CrowdStrike. MRVL, very interesting from a semis perspective. Broadcom, semis perspective as well, and Costco. Those would be the names that primarily I would be concerned about this week, but we're through the bulk of earnings season right now. I would say that this is probably less of a core component as to how the market reacts in the short term. Maybe because this is so involved with the semiconductor space, specifically Broadcom, in indices like the SMH and the SOXX, probably worth paying attention to that one. That's Thursday after the close, Broadcom earnings. For the semi space, make or break has the potential to continue acting as a possible downside target. MRVL is interesting because this is actually the trade idea for today's episode. We'll get into that after we do a quick rip through the supporting evidence categories. Let's see how quick we can do this. Like I said, I know I make the promise sometimes, but don't do it. Risk off out of TLT ratio to the S&P 500. We're watching that. It doesn't really help the market's case for upside. As we look at bonds relative to themselves, it just looks like the long end of the curve is getting more love, which appears to be market participants sort of suggesting, right, hey, let's button things up here a little bit on the recession narrative at least. Let's move into credit spreads. Uptick here is concerning. We want to watch to see if it actually takes place in junk as well. This is a corporate grade. This is junk. We want to see the proxy here for junk also see an uptick. And I think that this aligns with the rotation conversation we were having, which is just that like, if you think that this has been like aggressive sell side activity, oh my God, I can't believe the market's down at the bottom end of the balance range. Like, buckle up, because when and if, keyword and emphasis if, it gets real and we see a spike in credit spreads, I mean, the S&P 500 is going to be, 5,000, 4,800. I'm not trying to forecast that. Trust me, I don't want the S&P to go there from the long-term perspective. I would love it if things just remain status quo, but when and if this gets wild, you're going to know and you're going to feel it. So watching these credit spreads here, they have not spiked or done anything to expand in a major way over the last little bit. If we look at the HYG in isolation, it does continue to be divergent here, and I think that that's still more of that flight to safety style aspect. If you go back to the dot-com bubble burst as well as the great financial crisis, although the HYG was not totally in effect for the earlier of the two, the dot-com bubble bursting, at least this version of the ETF, you'll notice that there's still outperformance from the HYG when the market is in a downdraft. So this doesn't really shock me. It still seems like a lesser step. It's associated with less risk than just being long equities, right? You could go LQD as well for corporate grade bonds, and you're noticing here, there's an inflow to corporate grade bonds as S&Ps generally sell off, which is a similar proxy to just using the TLT anyhow. So that's the conversation on that. Bonds generally still speaking to risk-off environments. Bitcoin speaking to risk-off environments, although I don't know how long it's going to last here. I'm very interested in buying the pullback at 71.5, even if it's just for a counter-trend move up into the overhead supply. I think there's a trade here that can be had out of Bitcoin, so watching that, but as an indication for the market, it does appear to be a little bit more risk-off. Let's take a look at breadth. which has not been helping. Small uptick out of the 50 SMA given Friday's rally, some stocks recovering that, but for the most part, new highs versus lows on a downtick, as well as the 200 SMA here. The concern is that this has not rallied back into its more comfortable spot, which indicates just broader health for the market as it's hovering maybe closer to this area up here. Oh, it looks like Thinkorswim is maybe going to seize up on me as we maybe get some updates here. It is notoriously a little late, 5 o'clock. Maybe they're pushing their software updates. Anyhow, let's see if we can't get through the remainder of the video without it completely seizing up. RSP, long off the possible 178 hold here, is just generally more neutral for the market. I wouldn't say it's an outstanding bullish piece of evidence saying that we should be back at all-time highs. If we do this and the market's lagging down here, that would certainly support, okay, divergence, bullish. Let's take a look at the equal weight NASDAQ supporting off of its key area. So, not Armageddon yet. If these things start to deteriorate lower highs and then equal lows are found, rough. That's probably leaning more so into that larger deterioration here. Transports have been divergent for like eons at this point. Not much to learn from that. If we look at VIX, here's another sort of like, this is just, you could say credit spreads are almost a proxy for volatility to some degree, but no spike. No 40 handle on the VIX. So one more time, if you think this has been bad, like just wait until the VIX gets up towards the 40 handle and it's truly like a capitulation style bottom. We're just not there yet out of the VIX. VIX is not always all that helpful, but the VVIX certainly gets a little bit closer underneath the 120 handle. So again, this has hardly been anything yet. If we take a look at volatility futures, this is actually, I got something new for you. Instead of building this script, I was unaware, but you can actually look at this, and I'll show you the version in just a second. You can look at these contangos versus backwardations in a totally different window. So notice that we are still in contango. We're still over the zero mark. So has volatility really lit up like a Christmas tree? Oh my God, the market's going to crash and burn. Nobody wants to own anything. No, hasn't been the case. So what I'm talking about is if we go over to the trade tab and let's pop in, whoa, we don't want the Forex trader. We want all products. We want the VX with 1/ please. We want to go to the VIX futures, and then you could hide this. You could hide the options chain. You want to go to product depth. Look at the futures tab over here, and this is going to show us, I have this set to all expirations. You could change this, I believe. Where is it? There's a setting in here to, here we go. You could change the series. You could choose to look at a shorter amount or not, but regardless, the point being is that as this line is looking like this, it just means that May is pricing in more volatility than the current contract for April. Same thing for June is over May, so on and so forth. And like generally, the volatility curve here is appropriate. It's not suggesting that there's any major backwardation in the VIX curve. I mean, simply put, what starts to become concerning is if you notice this, like these near-term expirations, right? Because that's really what this is, April, May, June, so on and so forth. If these invert, and let's just say that April jumps up to, let's make up a crazy example. Let's say it goes to 19.9 up here, and this dot is this, and then the next one is sort of like down here, and then the next one's down here, and then like this. If the curve looks this way, this is where you duck and cover, and oh my God, like volatility's here on our doorstep. Market's probably crashing at that point, right? And we're just not there yet. So the takeaway from all of this is just simply like, as we remain in the balance range out of the S&P 500, let's go back to this view here. As we remain in the weekly balance, which I would describe as this box, yes, there's a bearish edge that we've explored in today's episode, but like, be prepared for things to get real if we get this kind of look over here. And it's, you might get like, I've drawn in this smooth little arrow and like, oh, it looks so gentle and calm, right? But it's probably going to look like big red bar. And I'm not saying this is the forecast for this week. We've already gone over the forecast. I'm saying this is what it looks like when, things hit the fan. Maybe you get like one little up bar with an upper wick, and then, it's this, right? It's a gap and go. It's oh my God. And again, I'm not trying to say the market's going to like 520 in the next little bit, but volatility has basically shown us that this is nothing. This is hunky-dory consolidation in the box. Lower those position sizes, and just to get to some more maybe actionable takeaways, right? Widen up the stop losses. So let's say widen up the stop losses, lower the position sizes, have some confidence in the levels. Your levels, you should have some faith in them, but make sure that your stop is not set so razor tight and you're so over leveraged in the position that you freak out as soon as like the level gets tested and like there's not a definitive break. So that's the full rant, I suppose, of today's episode. A lot of commentary packed in here that is, on the peripherals of like directly what the analysis is. And again, I would really appreciate some feedback in the comments if you like it, if you don't like it, if it makes the videos unbearable to watch. You're probably not even here at this point. But anyways, what do we see? Core list of companies, one trade idea. You know what it is. It's Marvel. What do we see? NVIDIA is underneath the overhead supply. Lower high opportunity under 129. Equal lows sets some sort of like, head and shoulders under the neckline. Sayonara, moving lower, right? So I think in the deep seek range, bears are in control. And you could frame it this way. Put yourself in the shoes of a buyer on Thursday morning as we open up on a very mild gap up from earnings. Okay, NVIDIA beats the numbers, not by any impressive margin. They offer very similar guidance to what they've done over the last little bit. We technically get a little mild gap up, right? Okay, gap fill reversal is probably the first idea, doesn't take place. Okay, we move into the prior day's range, not the best. Probably want to stay over 129, which represents the deep seek range. Okay, that's not happening. Okay, probably want to see the daily 200 SMA hold up. Okay, that's not happening. We probably want to see this hold up, the prior low. That's not happening. Like, this just has red flags written all over it. Now, it's definitely possible, right, that a counter trend move continues a little bit, but I would not generally take a long stance on NVIDIA until there's clear acceptance back over 129. And when I say acceptance, as I've already described a number of times in today's episode, it's a higher low above that level. And, the time frame then has to become appropriate to your level of execution. If you're like an investor, you probably want to see like daily higher lows, weekly higher lows over 129 before moving back to all-time high. If you're a, intraday scalper, you're probably looking for like 5-minute higher lows over 129. But generally, that's the number. That's your over and under level out of NVIDIA. That's like the only comment I have for this chart. If we're under 129, I think it's very difficult to have all of this overhead supply after highs, lower highs, lows, lower lows, equal lows. You're telling me that you think this is an uptrend that's buyable? I mean, there might be some short-term opportunity, but for the most part, I don't see the light at the end of the tunnel anymore for NVIDIA, right? Wall Street is greedy. They want more, and the $2 billion beat and raise is not enough. Right? It's the same old song and dance. They're getting tired. What's the next shiny object, right? Microsoft, hard look, right? Underneath this overhead supply, I think it's one of the reasons why on the XLK there's such a bearish influence, of course. Any lower highs under 403.25, I'm just going to leave you with simple levels this week. 403.25. If you're under that level, the bears have total control. This is a bear flag, and over time, we're looking for lower. If it's look below and fail, again, depending on your time frame of execution, you got to get over 403.25. Apple, weekly key level is absolutely key. This one's really funky. There was like a crazy 2-minute, 1-minute lower wick, like almost right off of the open. I don't know how true of a print that ultimately was. It's like my eyes went to another chart for 2 seconds. I look back over and there's this nasty lower wick. I'm almost, inclined to like omit some of that price activity there, but I like how it's holding the weekly key level. I like how this is a potential higher low, lows, higher lows, higher lows. If we make it back up to the equal high, I would be very interested in this as an ascending triangle breaking out through 247.25. So you want your key level on Apple, it's 247.25. And you have to keep this higher low over 237.25. Amazon is up next. Lower highs underneath 219.25. Keep this as overhead supply. Beautiful on Thursday. Nothing more to say. 219.25 is your over or under. If we're below, technically looking more like a bear flag. Rejections of these all-time highs, overhead supply, seeking sideways or even downside outcomes. If we're going to improve, show me the higher low above. Next up, Google. Not as easy, right? Because here I think there's much more of an opportunity for a bit of a counter trend move. The reason I say that is because this has been nearly straight to the downside. Notice how on the Friday session, you look below and fail on the Thursday low. And if we take it to the hourly chart, there's some dotted line reference points that you can see in here, but these are not like the strongest levels that we've ever seen. These are not end-all be-all levels. If we start to see Brigade Bolt here, I will take the counter trend scalp from A to B. If we get a Brigade Bolt over B, we'll go B to C. And there's probably, it deserves to have another level. It would be the opening print of this bar around 178 flat as another level on your charts. Again, dim, gray, not a make or break level, but those would be your upside targets here. And I think a counter trend move would be reasonable. A lower high that's set under 182.50 probably starts to become a little bit more compelling for further downside. My first thought when and if we get here is to look for one of these and then start trading to the downside. I would love to be proven wrong. I would love for tech to make a comeback, but given the current stance of these charts from a technical point of view, Put yourself in the shoes of a buyer. Okay, we broke down from this balance range after earnings. Got to hold these prior highs, right? You're long from this breakout. You're long from the Willow breakout. Seeing this move to the downside must be massively disappointing. Longs have either already closed or like, wow, get me out of this, break even as close as possible. Sell, 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 sell. Overhead supply weighs on price at that point. 182.50. Next up, Meta. Let's take a look. This one looks much different because I will say the trend preceding this is much cleaner in the upward direction. This looks like a weekly high or low. I should go back and I should find the screenshot of the video where I was like, hey, a weekly Brigade bolt here. It seems insane, but I would love to see it. There you go. It's in play right here, right now. Notice the double bottom out of Meta off of, and above even this breakout point. Very, very clean chart. Anything over the neckline there at 682.25. I think it's, back in the upward direction we go. So your one key level, I guess two, would be 682.25 and 635.25 are going to be your key levels out of Meta. That's the watch there. Here it is on the hourly time frame chart. You can see the double bottom. You can see how it emerges if we get consolidation over the devils in the details level. The 666, great first step, and then Brigade bolt here. I'm looking for the thin structure retracement into that 704.50. If we just consolidate here, call it for what it is. It's a lower high. It's an H pattern. Under the lows, I think we get a firm test into that 635.25. I would not be short on the lows. I would more so be interested in seeing what that response is there. So I think you could try short, risk reward here if there's a clear no-brainer rejection to get there, but I would not be a new money short at the lows given what we've just described on the daily, seeing this structure in the past. Tesla. It's do or die time. It is do or die time. Daily 200 SMA, top of this prior gap from over here, and the big retest of the weekly breakout level from the past. A little bit of a similar comment to Amazon, where it's been a straight down move. Friday is technically a look below and fail underneath Thursday's low, and we close back up at the highs. So it's do or die, as I've said. Here it is on the hourly time frame chart. You could start to make the argument for inverted head and shoulders on the hourly Brigade bolt. Here is a trade from point A up to point B. We'll be watching for that in particular. And then it gets even more compelling through the thin structure of this. Nasty day, of course, Tuesday. Big sell side activity. 326.50 is the target. Now keep in mind that this is a counter trend move until proven otherwise. If we zoom out on the daily time frame, we still have highs, lower highs, lower highs, lower highs, lows, lower lows, lower lows, all the way down here, lower lows all the way down here. So if we do rally, 326.50 is a great spot for another lower high. If this is the start of a stronger base, we will pull in for a higher low after that, and we will have a daily reversal. When and if that takes place, great. Maybe there's a stronger move to the upside, but until that actually happens, yes, you could try risk reward, very tight stop for the counter trend, but remember, it is a counter trend move until proven otherwise. We've chosen our words there very carefully. Let's move along to JP Morgan. So financials making a little bit of a comeback at the high end of the bull flag on the daily XLF. You can see we're a little ways off the all-time high here out of JP Morgan. So what does that mean walking forward? You've got to see price acceptance remain over 260.60, and maybe we've neutralized here. Anything that slips back down below, I really think you're looking at a big-time lower high opportunity and then an equal not an equal, but a lower low from here to here to retest the earnings sort of breakout level, right? So 248 after a lower high, definitely on the table and something to be mindful of. If this takes place, if the XLF gives up some of its relative strength, what does it spell for the S&P 500? Trouble. Let's move along to Netflix, building out a head and shoulders. Watching for this as long as price remains underneath 999, building out that consolidation. I wouldn't just be arbitrarily short in this range. I would want something in the gap range from earnings that's under 950.25. Let's finally finish it up with MRVL and just point out that this is a higher time frame watch. Let's go to a weekly on a 5-year outlook, and it's a big retest of excuse me, it's time to end the video, isn't it? Big retest of the previous all-time high coming into that little shelf of resistance in here as well. You've noticed, and if we just quickly flip back to the daily, now that I've shown you this context, what this level is, let's go back to the daily. We've obviously overshot that level by a bit on the Thursday breakdown, but the daily 200 SMA is here. Earnings are this week, so we'll watch out for this. I think the play here is to probably, if something happens ahead of earnings, then fine, maybe we get a quick scalp out of it. But if post earnings, let's just say that NVIDIA takes the brunt of the hit, excuse me, for semiconductors, and there's a recovery. If Marvel opens and can stay over 92.75, it might be worth starting to look for long opportunities back in the upward direction towards, what would be the level up here around 111. 111, the origin of the most recent breakdown seems to be a potential target we could look for. Something along these lines, right? Off of the retest of the prior all-time high. If we do continue to extend the losses to the downside, this shelf, a little bit more obvious on the daily, but that 78 could come into play as a potential long area as well. And with that, as the voice starts to crumble into the end of today's analysis and commentary in detail, we will end the video there. I appreciate you coming out to the show. If you learned anything new, and again, if you did make it to the end, it's a long one, give me that feedback, because if you're not here for the commentary and just want to know the levels, you want to know my thoughts outside of the peripherals, then we'll cut these video lengths down. I like having the conversation, helps me work through my own thoughts, but if I have to do that by myself, then that is A-okay. So let me know in the comment section. Give the video a thumbs up if you haven't already. Subscribe to the channel, and we'll see you back here on Monday morning, bright and early, 8 o'clock Eastern time, for a brand new episode of the Pre-Market Prep. And I would advise that you tune in, because we've got some office upgrades that we do want to share with you on that Monday morning. So make sure you come on out to the show. We've got something special to kick it off. There is your hint. So with that said, have a green trading week, and I will see you in the next one.